What's up guys, and welcome back to my channel, where today we talk about investing in shares for beginners in Australia. So stay tuned. I myself have learned how to invest in shares in Australia for the past 5 years, and I'd like to share my knowledge with you guys and help you guys out. If you guys like this, please like and subscribe and stay tuned. I might be releasing more videos like this, so please let me know. In this video, I'll be talking about how the stock market works. I'll also be talking about the different cycles of a company and what to look out for, what you need to start investing, and doing your homework properly to avoid any risks. So let's get into it. Okay, so number one, how does the stock market work? What is the stock market? A stock market is where traders can come and invest in a company. What happens is, let's say Apple, 100% of Apple is owned by the CEO Tim Cook. Now, if he wants to give out part of equity, which is part ownership of the company, he could trade shares for money in return. So Tim Cook can earn 50% of Apple, and another 25% is owned by investment banks, and the remainder might be owned by retail investors, which is you and I, investing to make money instead of letting it sit in a bank. With that part ownership of a company, you do not have managerial power, meaning you can't kick and bring in people as you like for as a CFO, CEO, etc. And you don't get to tell the people what products to put out and what not to put out. But with those shares, you do have votes. Now, if they want to vote against a certain CEO or a board of directors, you could contribute your vote and it could make an impact. Now, something that you need to be aware of is that the stock market is volatile, meaning that some days it's up, some days it's down. There's bubbles that occur and bursts that follow after a bubble. These bubbles and bursts occur because people are very emotional. When they see a trend on a stock or a market is inflated, that means that a lot of people are putting money into the market, making the overall market or a certain stock explode and go up. Now, some people think that they've missed out on a ride, so then they put in money to try and ride that wave up. After a certain point, that price is so inflated that people begin to pull their money out because they know a burst is going to happen. When investment banks, a lot of investors and companies pull out the money in a certain company, that's when a bubble bursts. Now, when a company or a stock bursts, everyone's pulling their money out, so the stock price keeps declining. You need to keep in mind that you need to be doing the opposite of what everyone is doing, like what Warren Buffett says. Whenever everyone is selling, this is a good time for you to buy. And whenever everyone's buying, this is when you need to be scared and selling. Warren Buffett always says that great investors have control of their emotions. Do not let emotions have control of you. One thing to help you out with investing in the stock market is that it's a long-term game. So when you put money into a company, you need to think that you've lost that money automatically and never look at it. Because when the market goes up and down, your emotions will be like, oh, I need to pull out my money, or I need to put more money when the time's not right. And one way to avoid these impulse decisions is to either not look at the stock price when you've invested, or to keep increasing your knowledge by reading more books, listening to great podcasts and investors, and constantly learning through failure. Now, there's also different stages of a company. There's the initial startup company, which then starts to grow. Now, the upscale is called the growth stage. That's when companies are growing so fast and trying to scale so much. That is when you see like a stock like Afterpay in Australia, where it used to be $7 and now it's at $154 because of scale. Everyone's investing in it because they see how fast the company is growing. When you reach to the top, that's when the company has matured. Okay, that's a company like Apple, where everyone knows who they are. They're a big company. They're well founded. They've got good amount of cash settled. They've got good amount of cash. Then after the maturity curve, that's when a company starts to decline. That's when a company is not innovating, creating new products, and just milking the same old cow. What happens is, for example, let's say Apple stopped innovating and they only sold an iPhone. They stopped selling iPads and iMacs and all that, just an iPhone. Eventually what happens is all the profits that the company is making, they'll just start to distribute that as dividends to the investors instead of reinvesting into the company. Eventually people will stop investing in Apple because it's not innovative and it's not reinvesting the money to continue the growth. So that starts the process of the decline curve. Now, what is a dividend? A dividend is when a company pays out to investors the remainder of their profits after expenses. Once expenses is deducted from their revenue, the total profit can either be given out to customers in cash, which is what dividend is, or it could be reinvested into a company to continue to grow. The money used to invest back into the company could be used for extra machine, extra land, research and development, or simply to scale bigger. The cash received from a dividend can be put into your bank account, or you could set up a reinvestment plan, which means that whenever the money comes, it collects until you have enough for a share price, and then it rebuys that. So over a long time, your wealth compounds. Some companies pay out dividends every year or every half a year. Now, this is a strategy for people to make passive income where they just unload their money into a company that pays high dividend and keep receiving passive income. Now, how do investors make money if a company doesn't give out dividends? The answer is capital growth. With capital growth, after time, a company's stock price will eventually go up. For example, let's say ZipPay is currently $10 and then it goes up to $13 in a couple of months because they've released good information, they're expanding, people have more faith in the company. So over that $3 profit over how many shares you have is the capital growth. That is the profit that you'll be making. Now let's get to the second part of the video. What do you need to start investing? Number one is liquid cash. You need cash to open up a brokerage account to start buying stocks. If you're in debt, I do not recommend you buying stocks. Instead, try to pay off your debt because you're paying interest on that, and whenever you're debt free, you can start using your extra savings to make more money through the stock market. And as I said previously, whenever you put money into the stock market, pretend like you've lost it 100% to avoid an emotional roller coaster. Number two, you'll be needing a trading brokerage account. This could be with the 4 major banks or a smaller bank. The differences between them is usually the fee, the brokerage fee per trade, or the layout and setup of the account and how to trade, the charts. Depends what you're into. Make sure to do your homework. One of the biggest brokerage trading apps in Australia is CommSec, and I use that for trading stock in Australia. Okay, and finally the last part is do your homework before investing. These homework tasks are emphasized by Warren Buffett. Number one is to only invest in industries that you understand or work in. Okay, so if for example you work in the retail industry, you do not want to go and start investing in mining companies if you're unaware of it. Or if you're in the medical industry, don't start investing in the tech industry. Invest in what you know. This way, it's easier for you to see trends in society. For example, if you work in retail, you start seeing clothing trends, technology trends, if retail shops are slowing down or growing, things like that. Number two is a moat. A moat is an advantage that one company has over another to give it that slight edge. So for example, Afterpay and the buy now, pay later industry versus credit cards, the moat is that there's no interest on the money borrowed to buy a certain product. Okay? Now you need to think that if banks try to do this, they'll be losing a lot of money because banks make money off interest rates. And if credit cards have 0 interest rates, then that'll be a big hit for banks. So you need to understand the different types of moats available with each company. You need to understand the company's moat and see if it makes a difference in the future or not. Another important thing is to do due diligence of co-founders and the executives. Now, some companies might be paying huge amounts of money to executives and they're taking advantage of that, using corporate jets for their personal use, going out on too many dinners that are unnecessary. So you need to understand the remuneration package and see if they're taking advantage of that or not. One of Warren Buffett's rule is that you check appropriate management incentives. This means that you need to look at the notes in the annual report section and you want a company that discloses how much an executive gets paid and which indicators an executive is getting measured on. Also look for rewards for long term. So for example, if executives and workers are getting shares of the company that they're working on, this incentivizes them to stay for a longer period of time and to work even harder so their share can appreciate over time. And that's it for today, guys. Thank you very much for watching. Just a reminder, please like and subscribe if you like this. If you want me to make more videos like this, it will mean the world to me. I'll try to be making more videos about which brokerage to use, the difference between investing in stocks in Australia versus the US, the advantages and disadvantages, and yeah, so stay tuned.